Elon Musk recently did something no human has ever done. His net worth crossed $1 trillion. This chart shows a timeline of human history, mapping what a trillion actually looks like. If you started counting $1 per second, you would be counting non-stop for the next 31,700 years. If you liquidated that amount, you could pay to feed every single person on Earth 3 meals a day for 60 consecutive years. Or, looking at it locally, you could hand a check for 60,000 rupees to every single citizen in India. These comparisons highlight the shift from private wealth to a level of capital that rivals the annual GDP of major nations. At this scale, one person's financial moves carry the weight of a national budget. But reaching that 13-digit peak comes with a catch. Maintaining that valuation is actually much harder than hitting it in the first place. That's because we are dealing with paper wealth. A $1 trillion net worth doesn't mean cash sitting in a physical bank vault. It's a mathematical estimate tied to the stock market. When your wealth is entirely locked up in company shares, it fluctuates second by second as investors buy and sell those shares. A $1 trillion valuation is actually a fragile consensus of public belief. The moment investors lose confidence, that peak begins to crack. To understand how Musk's net worth climbed that high, we have to examine his actual portfolio. He owns stakes in over a dozen distinct, highly speculative companies. The largest pillar of that fortune is Tesla, a company that dominates the clean energy and automotive sectors and accounts for a massive chunk of his total equity. Then there's his $44 billion acquisition of Twitter, now known as X. Controlling a global media platform shifts his portfolio from manufacturing into direct public influence. He also holds major stakes in ventures like Neuralink. These companies deal in brain-machine interfaces, technology that links the human brain directly to computers. Bets on sci-fi concepts like this inject massive speculative value into his net worth. You have an electric car giant, a global media network, and experimental brain chips. This web of high-risk companies stacks together to create an intertwined corporate valuation. But what finally pushed that combined corporate valuation over the edge was his absolute dominance in the aerospace sector. This chart tracks Musk's net worth. The line spikes violently, reflecting investors pricing in the SpaceX listing. Starlink's satellite internet fed this surge, promising a global monopoly. This capital influx provided the exact push to cross the $1 trillion line. Crossing this threshold required a specific alignment: the tangible dominance of a private space monopoly meeting a market eager to bet on its future potential. A beat of silence. Exactly 13 days after making history, market forces downgraded him back to a billionaire. This side-by-side chart contrasts the peak valuation on day 1 with the heavily reduced valuation on day 13. This drop is what analysts call a market correction, a period where overvalued stocks adjust back down to reflect their practical worth. During that 2-week window, the broader tech sector stumbled. Tesla shares took a noticeable hit amid concerns over profit margins, wiping billions off his ledger in a matter of hours. This whiplash shows how rapidly speculative momentum can reverse into a crushing financial penalty. Modern megawealth is a reflection of perceived future value. It isn't built on historical profits or liquid assets you can easily spend. Because it relies on the future, it is highly volatile. Market sell-offs target and dismantle non-liquid, tech-heavy portfolios when investors pull their money out. This suggests that a $1 trillion net worth is a fleeting measurement of market sentiment, existing only on screens until a stock price changes. In the era of tech valuations, the highest financial peaks are also the most precarious. They vanish as quickly as the headlines announce them. June 12, 2026. At 9:30 in the morning, a company called SpaceX began trading on the New York Stock Exchange. In the very first second of trading, its owner, Elon Musk, became the first person in history to reach a net worth of $1 trillion. To understand that number, think of it in terms of time. 1 million seconds is about 11 days. 1 billion seconds is 32 years. But 1 trillion seconds takes you back 31,000 years, to a time before the beginning of human civilization. Despite this figure, Musk has stated he holds only 0.1% of his wealth in cash. The rest is paper wealth, locked in the shares of his companies. He cannot simply withdraw this money. If he tried to sell a significant portion of his stock, the sudden flood of shares would likely cause the market price to collapse. The strength of that paper wealth is further complicated by the reality of the companies themselves. SpaceX, the primary driver of this valuation, is currently operating at a deficit. In 2025 alone, the company recorded a $5 billion operating loss. Elon Musk reached this trillion-dollar milestone while managing companies that lose billions annually, a massive valuation built entirely on the market's willingness to prioritize his future promises over today's objective financial reality. In his book, A Random Walk Down Wall Street, Burton Malkiel describes the castles in the air theory of investing. It suggests that a company's share price can be driven entirely by psychological value rather than revenue or profit. Investors aren't buying the current math, they are buying a version of the future. In 2013, Musk proposed the Hyperloop, promising travel at 600 miles per hour. It generated national headlines and years of speculation, but by 2023, the primary company behind the concept was wound up without ever delivering a successful product. He made similar promises regarding autonomous driving and the Boring Company's underground tunnels. The reality in Las Vegas is a single concrete tube, where Tesla cars frequently encounter the same traffic jams they were meant to eliminate. From 2014 promises of humans on Mars to the 2019 claim of 1 million robotaxis, we see a decade-long pattern of unmet deadlines and shifting targets. The valuation of these companies relies on the continuous maintenance of a psychological narrative, the belief that no matter the current losses, Musk's name alone ensures eventual success. This raises a question. If billionaires have no cash, how do they fund billion-dollar acquisitions like Twitter? They use a strategy known as buy, borrow, die. To avoid paying capital gains taxes, they never sell their shares. Instead, they use those shares as collateral to take out large, low-interest loans from banks. To buy Twitter in 2022, Musk mortgaged tens of billions of dollars in Tesla stock to secure a $12.5 billion cash loan. He gained the liquidity he needed without ever triggering a taxable sale. The mathematical result is a system where the ultra-wealthy pay an effective tax rate of just 3.2%, while the average working-class taxpayer in America pays between 20 and 30% of their income. By utilizing these borrowing loopholes, billionaires can live on the growth of their shares, while shifting the economic responsibility of funding the country onto the general public. Psychological wealth is volatile, and protecting it often requires political intervention. During the 2024 election, Musk provided a $290 million donation to the Trump campaign, becoming one of the president's most significant donors. The subsequent administration granted SpaceX and Starlink control over the majority of low Earth orbit satellites, effectively neutralizing the market position of their primary competitors. This influence even extends to international trade. Following direct meetings between Musk, the president, and Prime Minister Narendra Modi, previous regulatory hurdles were cleared to facilitate Starlink's entry into India. Domestically, the regulatory pressure vanished. Dozens of federal investigations and court cases involving Musk's companies were dropped shortly after the change in administration. The boundary between private enterprise and government regulation has blurred. Musk is no longer competing within a neutral market. He is utilizing the machinery of the state to insulate and expand his net worth. This brings us back to the SpaceX IPO. To ensure its success, the SEC waived standard broker safety rules, allowing the company to be fast-tracked onto the NASDAQ with minimal waiting. This maneuver meant that $70 billion from everyday retirement and pension funds were automatically funneled into the company. Millions of Americans had their savings placed at risk just to facilitate this valuation. The scale of this wealth is often contrasted with global needs. An analysis by Oxfam indicates that a 10% tax on such fortunes could lift 800 million people out of extreme poverty. When the UN World Food Program director provided a specific plan to save 42 million people from starvation using just $6 billion, Musk did not follow through on his public challenge to donate. This scale of wealth is generated through tax-deferred borrowing, political proximity, and the persistence of a psychological narrative. To protect your own assets, prioritize your own skills and tangible results over the volatility of speculative cults. When we track the world's wealthiest individuals, the numbers eventually lose their meaning. We're currently looking at a figure hovering around $250 billion, a sum so massive it mirrors the entire gross domestic product of nations like New Zealand or Greece. This figure is often labeled as Kul Sampati, a Hindi term for total wealth. However, that label implies a level of liquidity that simply doesn't exist. It suggests a bank vault filled with gold bars, when the reality is far more abstract. This fortune is not cash. It exists in a state of constant motion, distributed across public stock markets, estimated private equity, and billions of dollars in personal and corporate debt. To find the actual value within that $250 billion figure, we have to look at how the empire is actually constructed. Tesla is the most visible pillar of this wealth. It is a massive physical manufacturing operation, yet its contribution to Musk's net worth is defined by the financial markets rather than the factory floor. Because Tesla is a public company, its value is decided second by second on public stock exchanges. Investors set the stock price, which is then multiplied by the total number of outstanding shares to determine the company's total market capitalization. This chart shows how Musk used that valuation to build his personal stake. He famously waived a standard salary in favor of a performance award package. If Tesla hit specific, aggressive revenue and market value milestones, he would unlock massive blocks of new stock options. As the stock price surged, those milestones were met. The options unlocked, and the public market valuation turned those shares into tens of billions of dollars in paper wealth. Tesla functions as the public engine of the fortune, converting market enthusiasm directly into highly visible net worth. The second pillar is SpaceX. While the company produces tangible value by landing reusable orbital rockets, it presents a different financial problem. Because it is not publicly traded, there is no ticker price to tell us what it's worth. This concentric diagram illustrates how private value is set. Instead of an open market, the company's worth is determined through private funding rounds. A small group of venture capitalists agree to buy a percentage of the company at a specific price, setting an implied value for the whole. Even a minor transaction can shift the math. If an employee sells a fraction of their shares to an investor at a higher price, it recalculates the estimated value of Musk's entire majority stake in an instant. This means a significant portion of his wealth is theoretical, relying on the consensus of a few private investors over a broad public market. Beyond the core pillars, the portfolio includes significant wildcard acquisitions, most notably the purchase of the social media platform X. These are joined by infrastructure projects like the tunnels of the Boring Company, adding layers of complexity to the overall portfolio. This balancing scale shows the mechanism that connects these assets: leverage. To fund new acquisitions without selling his stock and incurring taxes, Musk borrows cash from banks, using his shares in Tesla and SpaceX as collateral. If the value of that collateral falls too far, the banks can demand immediate repayment. This creates a cascade risk, where he might be forced to sell off assets rapidly to cover his debts. This debt makes the entire empire interdependent. A crisis in one company's stock price can mathematically threaten the stability of his entire personal valuation. When we combine the public shares, private equity, and leveraged debt, we return to that total figure of $250 billion. That we can see now that this number is not a record of past profits. It is a real-time betting market on his ability to meet future promises. The valuation remains stable only as long as investors believe these future milestones will be met. The moment that collective belief wavers, the mathematical foundation of the entire empire begins to shift. The billions are real as long as the momentum continues. But because this wealth is built on expectations rather than cash, a change in sentiment can make a paper fortune disappear as quickly as it was created.